Welcome to the deep dive. Today, we're strapping in for a fascinating look at what feels like the market's core paradox.
A big one.
Yeah, you send us this whole stack of market research, all focused heavily on Federal Reserve rate cut expectations.
hmm
And the central question that just jumps off every single page is, well, it's confusing. How on earth does bad news for the economy, like a slowing job market, translate directly into a massive, giddy stock market rally?
That confusion is, it's completely understandable. If you're watching the news, you see labor conditions cooling, but then your brokerage account is suddenly soaring.
The logic feels broken.
It does. So our mission today is really to simplify the machinery behind that movement. We're going to trace the exact chain reaction
Okay.
from a single negative data point through investor psychology, Fed signaling, all the way down to which sectors when and why.
So by the end, we should see the clear, logical steps that govern this counterintuitive move.
Exactly.
All right, let's unpack this. Let's start with the specific event our sources highlighted, the Catalyst Day.
This is a day when U.S. stocks, pretty much across the board, close significantly higher. That's the end result. What specific piece of data hit the wire that morning to kick all this off?
The trigger was, well, decidedly weak labor data. And this wasn't even the government's big formal jobs report.
Oh, interesting.
This was the ADP private payrolls report. And that specific report showed private sector employment contracting by a really notable 32,000 jobs in November.
32,000 fewer private payroll jobs.
Mm.
Okay. That is significant evidence that the engine of the labor market is finally decelerating.
It is.
Now, for the critical immediate reaction, what did the fixed income market, the bond market, do the millisecond that data hit?
It was instant and totally predictable. The market interpreted this contraction as a signal of a cooling economy.
And by extension, cooling inflation.
Exactly, cooling inflationary pressures. And since bond prices move inversely to their yields, Treasury yields just dropped sharply.
And that drop is the first domino. That is the crucial first domino. Because suddenly fixed income is less competitive, so capital immediately starts looking for better returns. It sets the stage for the equity rally.
Okay, this is the moment. We need to bridge this logical gap for everyone listening. We've got weak labor data on one side and a strong stock rally on the other. Why does that weaker labor data, this sign of an economic slowdown, increase the probability the Fed will cut rates at their next meeting?
Well, it all comes down to the central bank's mandate. The Federal Reserve's main job is managing inflation.
Right.
For the last couple of years, the job market has just been too strong. It was generating wage pressure, which fuels inflation. So when the labor market finally shows real signs of weakness, like losing 32,000 jobs, it eases that pressure.
It's like the economy is starting to do the Fed's job for them.
That's a perfect way to put it. Weaker labor data means the Fed's primary fight, the inflation fight, is being won naturally by the economy itself.
So if the economy is winning the fight on its own, the Fed doesn't need its foot pressed so hard on the brake pedal anymore?
Exactly. The expectation immediately shifts. If inflation is cooling and the economy is slowing, the risk of over-tightening, of causing a really serious recession, it goes up. So to avoid that, the Fed is expected to pivot from raising rates to cutting rates, what we call monetary easing. It keeps the economy moving and avoids unnecessary pain.
That makes sense as a macro policy move, but let's get really specific about why the expectation of lower rates translates into higher stock prices today. This is the crucial, almost mathematical insight.
Right. This is where we have to talk about valuation models, specifically something called the discount rate.
The discount rate, okay.
So imagine you are guaranteed to receive, say, $100, but 10 years from now.
Okay, future money.
Exactly. What is that $100 worth to you today? Well, if prevailing interest rates, the risk-free rate, are at 5%, that future $100 is worth a lot less today.
Because you could just invest a smaller amount of money now and easily grow it to $100 over those 10 years.
You've got it. So the interest rate environment determined how heavily you discount that future guaranteed profit.
Right.
Now, if the expected interest rate environment drops from 5% down to, say, 3%, that means your money is making less just sitting in a safe bond.
So that future $100 looks a lot more attractive.
Suddenly, to get that future $100, you're willing to pay more for it today. That reduced discount rate mathematically increases the present value of all those future corporate earnings.
That is a fantastic way to explain it. So the instant the market believes rates are going down, the fundamental mathematical value of nearly every stock on the board goes up.
Yes, because their long-term profits are worth more in current
So
dollars.
it's the engine of the rally.
It is. It's
Yeah.
not just, optimism. It's a required upward recalculation. The lower yields increase the present value of future earnings, which provide the bedrock justification for higher stock valuations across the market.
And beyond the math, you have the practical, real-world benefits for corporations. How does cheaper expected debt change the behavior of, CFOs and CEOs?
It changes everything. Corporate strategy shifts from being defensive to going on offense.
Okay.
Think about mergers and acquisitions. M&A activity needs financing. Capital expenditures, like building a new factory or investing in R&D, that all becomes cheaper.
Even stock buybacks.
Especially stock buybacks. They become a more attractive use of capital. Cheaper borrowing just greases the wheels of the economy.
And when investors see all this potential activity, this future growth unlocked by cheaper money, where do they put their cash?
They shift toward what we call risk assets.
Right.
Risk assets in this context are just things that carry more volatility than safe government bonds, so primarily stocks.
So when bond yields are low, the return for safety is just not worth it.
Yeah, investors basically say, I'm not getting paid enough to sit safely in a bond, and they move their money into stocks. And that gives you that broad market lift.
Perfect. Okay, so we've established the mechanism. Weak data, falling yields, mathematically boosted valuations. Now let's get into the market color and the implications. If every stock gets a boost, who benefits the most? We know the broad indexes were up, but the sources point to two categories specifically that outperformed: tech and growth stocks, and cyclicals. Why them?
This is the crucial nuance. While, all ships rise on a flood tide, the technology and growth sectors, they just rocketed up. And this ties directly back to that discount rate effect we just analyzed.
Okay.
We often refer to these growth companies as long-duration assets.
Long duration, what does that mean in simple terms?
It means their value is tied heavily to earnings projected far out into the future, 5, 10, sometimes 15 years from now.
So they might not be super profitable today, but they promise massive profitability later on.
Exactly. And since the bulk of their money is coming in the future, they benefit the most dramatically when you lower that discount rate. A small reduction today has an outsized effect on the present value of a profit that's a decade away.
Got it. So the tech company whose valuation is based on world domination 5 years from now sees the biggest present value jump.
Right.
While the grocery store, which just makes consistent profits every single quarter, sees a smaller relative boost.
Exactly. Their sensitivity to rate expectations is maximal. And this is why the fall in bond yields, specifically the fact that yields fell across the entire maturity curve, not just short-term rates, gave such a huge signal of conviction.
So the bond traders were betting on a long-term shift.
They were a long-term shift toward easing.
That explains growth and tech. But what about cyclicals? I mean, these are companies like manufacturers, heavy industry, or even high-end consumer discretionary firms. They rise and fall with the economy. Why do they do so well?
Their gain is driven more by pure economic confidence and borrowing costs. Cyclicals thrive when the economy is robust and expanding. So if the Fed is expected to cut rates, it signals that the central bank is actively trying to prolong the economic cycle, or at least prevent a downturn. And that confidence makes CEOs more willing to invest and consumers more willing to spend.
And they often need a lot of debt to function, right? I'm thinking manufacturing, housing, very capital intensive.
Absolutely. Think about the housing sector. It's the definition of rate sensitivity. Lower expected rates mean lower expected mortgage rates.
Which brings demand right back into the market.
Right back. And that directly benefits housing starts, construction companies, home improvement retailers. The benefit to cyclicals is, I'd say, more immediate and practical than the pure math boost you see in tech.
This all paints a very bullish picture for the short term. But the sources stressed this rally is incredibly fragile. What are the key downside risks that you need to be watching for?
The primary risk is that the rally is built entirely on the expectation of future weakness and those rate cuts. The rally is a bet.
So if upcoming data surprises the market by being too strong, that bet reverses instantly.
Instantly.
What kind of surprise data would derail this whole narrative?
Well, if the next big jobs report shows a massive unexpected increase in hiring, or, crucially, if the inflation metrics suddenly spike up again.
Because if inflation reaccelerates, the Fed simply cannot cut rates.
They can't. In fact, they might have to signal the possibility of hiking again. And if that happens, you'd see yields shift back up, and those recent equity gains, especially in those rate-sensitive tech names, would be wiped out very, very quickly.
So you need to monitor two specific catalysts above all others in the immediate future.
Correct. The upcoming Consumer Price Index, the CPI data. That's the definitive measure of inflation. If CPI comes in hot, the narrative is crushed.
And the second.
The next Federal Reserve meeting itself. The market is pricing in a cut. If the Fed meets, and not only doesn't cut, but speaks hawkishly.
Let's quickly define our terms. You said hawkishly. So a hawk versus a dove.
Right. A dove is a central banker who favors policies that prioritize growth, which usually means lower interest rates. A hawk prioritizes fighting inflation, beating higher rates.
So if the market is expecting a dove speech and gets a hawk speech, even if they don't hike rates, that disappointment alone could trigger a sell-off.
A huge sell-off.
Yeah.
The market would interpret that as a major letdown.
This has been a complete, really logical tracing of this market event. So to summarize for you, weak labor data, specifically that contraction in private payrolls, increased investor confidence in near-term Fed easing. That confidence caused Treasury yields to fall, and that reduction in the discount rate mathematically boosted the present value of future earnings. It lifted stocks, with the largest gains seen in rate-sensitive tech and housing-related cyclicals.
That mechanism is now yours. You understand the what and the how. But, financial literacy isn't just about observing. It's about anticipating.
Right.
Now that you know the mechanism, you have to ask the next layer of challenging questions about market positioning.
So let's leave you with the final provocative thought, drawn from the deepest implications of our source material. We know rate cut expectations are driving the market right now, but we have to seriously consider, are those expectations already fully priced into equity valuations?
Or is there still room for these sectors to run higher if the Fed actually confirms the pivot?
And if we connect this to the bigger picture of how you manage your own wealth, this raises a really important question you should be tackling.
Yes. How should you approach balancing duration risk? That's the sensitivity of your existing bonds to rate changes versus your equity exposure and portfolio, given that these expectations are constantly shifting and are inherently so fragile. That analysis is the true test of this knowledge.